Hi, I'm Bruna Bauer. I'm the Impact Lens research, and I'm delighted to be joined by Karen Shackleton, the founder of Pace for Purpose. We've been working on a couple of really interesting research pieces, one looking at venture capital and another one exploring the insurance sector. In this conversation, we will talk about what inspired this work, what we've learned, and where do we go from here. Karen, can I ask you what first sparked our interest in venture capital, and why did we feel that it was such an important area to focus our research on?
Well, it's a really good question. It occurred to me, I mean, I speak to a lot of pension funds, and it suddenly occurred to me that I had never once had a discussion with them about venture capital as a potential investment. Yet when I looked at the US market, US investors were very commonly investing in venture capital, and it seemed like there was a disconnect there. That was the primary reason for thinking about research, but also I thought that venture capital really did align to a number of impact themes that our asset owners were interested in. So, for example, climate tech, life sciences, just to give some examples. And then also we had that impetus from governments. In the UK, we had the Mansion House Accord, for example, is a very supportive regulatory environment at the moment, encouraging pension funds and other asset owners to invest in growth in the UK. So that was really what was driving it.
Mhm.
Bruna, can you talk us through how we approached the research process? And you obviously doing the work. What steps did we take, and how did we engage with the industry to gather key insights and findings?
Yeah, so of course, we already had some data in terms of how much European pension funds were allocating to VC. So we did know that they were not allocating at all. The focus was really to understand why European pension funds were not allocating to venture capital, and also the investment cases for those doing so. We engage with pension funds from the UK and from different European countries, and we found that portfolio diversification is still the main driver for pension funds to allocate to venture because of the low correlation with traditional listed markets. However, we also found out that VC's alignment with sustainability is also a growing reason for allocation, especially here in the UK. And the reason for that is that VC funds usually back up startups that are driving change in areas like climate, health, education, and so on. However, we also understood that there were still some challenges, especially when it comes to pension funds allocating for the first time or increasing allocations to VC. The top one would be there is a huge need for education. That's something that we've heard, especially from trustees here in the UK. They really want to learn more about how VC works in general, its risks, the different funding stages, vintage diversification. As a consequence of that, of course, there is a second reason, which is pension funds, they still view venture capital as too risky, especially because of the performance inconsistency across fund managers. So because of those challenges, Kai, I wanted to ask you, what do you think that could be done to address those challenges?
Okay, so first of all, education, this desire to understand more about VC. What does success look like? What does failure look like? We're working on a training workshop, which we're hoping to roll out for our asset owner members soon. On the question about fees, I think that's really about encouraging venture capital managers to have greater transparency about how their fees are made up, when they will be charged, and hopefully that then investors can see that they're getting value add out of their investments in returns net of those fees. On scheme size, I think we had a lot of arguments in favour of fund of funds. Now, fund of funds have been looked upon less favourably by investors in recent years because of the extra layer of fees. I actually think in venture capital, it does make sense because you're outsourcing that ability to understand the market. It's a specialist area, and to do proper due diligence on the investments on the underlying funds. So fund of funds, I think, is the answer to the scheme team size issues that we heard about. And then questioning performance inconsistency. I think it's for the market to provide more evidence of strong and consistent returns. And we know that there are managers out there that can deliver that. So let's hear a little bit more about them.
We've also just undertaken research in the insurance space. So I wanted to ask you, why did we feel that was an area that was interesting for us to explore?
This really came about because there's a very real trend from closed defined benefit pension funds moving to buyout with the insurers. And I was quite curious as to what were the responsible investment practices that those insurance companies were doing themselves. We had heard that from some of the defined benefit funds that they're only going to think about things like climate change if the insurers are thinking about climate change, because all they want to do is get their portfolios looking in a way which will be most attractive to the insurers. So that was the primary reason. What are insurers doing? Broadening our asset owner reach, that's something that as an organisation we're very keen to do. And also we couldn't find any other research on this subject, so we're hoping will be groundbreaking research. Bruna, what were the key findings from this research? We've just finished it, so tell us what you found out.
Yeah, so probably the main finding that we're looking for, we've realized that insurance companies, they present themselves as responsible investors, but I would say that they're slowly transitioning towards sustainable investors. Several of them, they're applying exclusions, they're screening out some sectors. We also see that stewardship and engagement are increasingly important to them. Climate is a top consideration, followed by nature and human rights as well. Several of them, they've applied, they've set up decarbonization targets, and some exclusions to highlighting sectors. So we do see that they are progressing in that sense. However, we do see that the most of the insurance that we've interviewed, they outsource investment management. So they're really relying on the managers for their stewardship activities. What they've been doing is increasing sustainability assessment when selecting managers and also when evaluating them. One thing that we've seen is that insurers, they have very extensive experience when it comes to running scenario analysis, incorporating climate into stress testing, for example. But they are facing some challenges when it comes to translating those insights into decision useful actions. And the reason for that is that there is a mismatch between the long-term scenarios and the short-term decisions that needs to be made. So they are also looking for greater support from the managers in this area.
So when you compare the venture capital research and the insurance research, are there any common themes that stand out to you?
We'll have to go back to the educational gap I mentioned in the first question, because in both cases, those topics are still very new for both industries. Of course, internal capacity is limited. The teams, they just don't have endless resources. Pension funds, for example, they haven't historically allocated to VC, so there is a learning curve that they need to go through, much like the insurance companies are experiencing with sustainability. We see that insurance companies, they've been treating climate as a risk for a long time. And we also see that the access to the data is no longer the biggest challenge anymore. The real issue for them now is really to figure out how they're going to turn that information into decision useful insights. Of course, in both sectors, the conversation also very often comes back to fiduciary duty, whether or not those considerations are formally part of the traditional definition of fiduciary duty. They're really asking for further guidance from the regulator in that sense. I wanted to ask you, based on what we've learned, what role do you see pensions for purpose playing in helping to address these challenges that we've been talking about?
I think it's a question of us just doing what we do best, offering these training workshops, having discursive roundtables when asset owners can meet with each other and with third-party providers and talk about particular topics so that they gain their understanding, running in-person masterclasses, and of course we've got our annual symposium coming up on the 5th of November, which is really exciting. That's our in-person event. So I think it's just carrying on doing more of the same. But we are starting as well to do a little bit more policy work. That's perhaps a new area for us that we're working on.
And what's next for us?
Okay, so we're not stopping still. No twiddling of thumbs for us. We're currently just starting off some biodiversity research under our ecosystem theme. So that's kicking off. We're also hoping early next year to start research on our place theme. In our people value theme, we're thinking about doing some research looking at the ethnicity pensions gap. And we're also keen to do some standalone research looking at asset owners' attitudes to investing in peace and justice at SDG 16. Within that, thinking about their approach to investing in defence. So if you're interested, then please let us know, because we'd really like to partner with somebody to get that research off the ground. But basically, we're going to stay busy. We're really excited about what lies ahead. Thank you.